All right, everybody, welcome back to Arthur Invest. It's been a couple of weeks. I have been doing a little bit of PTO, some personal time off from work, spending time with the family, but I'm back here to bring you another video today. So, what is it that I want to talk about today? Well, what I thought would be great is to kind of catch up. There's a lot of stuff going on in the market. Some sales numbers came out this week I thought were pretty interesting, but what are we going to focus on today? So, I thought we would focus on inflation, right? This seems to be a topic over the past week and a half, right? This is everywhere, right? You're reading and following the stock market. Investors are getting really nervous and fearful about the inflation rate popping up to 4.2% last month, which is actually pretty notable. And so people are thinking that this is going to be a kind of long-term problem. And so you have the Federal Reserve saying on one side of the fence that this is really just transitory, meaning that as we start to have more inventory of very high stressed assets like copper and lumber and silver and all these other things, that will eventually subside, right? That'll go back down. But right now, for example, lumber, we're already seeing that come down. So they're saying you're going to start to see that roll across other asset classes as well. But then the investor side of it are thinking, look, you've pumped a ton of money into the economy. There's a lot of liquidity out there. Investors and even common folks are just flush with cash looking to spend. And so, what do we think is going to happen? Well, there's a lot of folks that think, look, inflation is here to stay. Now, where do I sit with this? Well, I think we're probably somewhere in the middle. I don't think we're going to stay at 4.2% over the next 2 to 3 years. I just don't see that happening. If anything, I think we change what we measure on the consumer price index to remove a couple more elements in there and kind of change the way that's done before we let that stay at 4%. But I don't see that staying at 1% either. So I think we'll probably see elevated inflation in the 2 to 3%, which is what the Federal Reserve has been telling us, if you've been listening to their reports, that they're going to try to target inflation at for the next few years. And that's actually a great thing. Look, I'm going to tell you right now, investing in real estate and just in general, if you have hard assets, inflation is your friend. So let me explain what I mean. Arthur, why is inflation good? Well, look, inflation is really good for people who have fixed interest rate debt. What do you mean by that, Arthur? Well, let me explain. If you have a fixed cost for something and you are making payments against it, well, as the value of the dollar decreases or the money supply increases, however you want to see that, you're going to be paying back your debts to your debtors with cheaper nominal dollars, right? And so let me give you an example. You buy a property for $100,000, your mortgage is somewhere around $600 a month. That's probably not super accurate, but it's probably within $100 of accuracy. You're locking in the costs for that property for the next 30 years. Now, that's granted you're getting, Fannie or Freddie made loans. You're locking that in for a period of 30 years. So what does that mean? That means you're essentially, to compare it to something else, what if you could buy a car that had a fixed price on gas of $3 a gallon for the next 30 years? That would be pretty amazing. And so we have this kind of weird backdoor loophole, whatever you want to call it, fixed interest debt for 30 years. And by the way, it's low. I mean, I just restructured almost all my debt for my properties, and we're hovering at like 3% for almost all of our loans. And our primary residence, by the way, 2.5%. So we're literally paying back the dollars for our debt much cheaper. So why is that good? Well, that's good because if you didn't buy a house in cash, that means you're letting your tenants pay back your debts. And as the value of the dollar decreases, you're still paying that minimal amount of money. And over time, the asset price of that property will go up. Am I saying it's going to spike like 20% year over year like the last few years? No, probably not that. But 2 to 3% inflation year over year is probably not crazy. That's more realistic in a normal market. Then you also factor in the fact that we're going to start to see wage inflation. Now, this is a key component. We have not seen that before. In the past 10 years, wage inflation has been pretty nominal. But one of the things that you'll notice coming out of this pandemic, employers are looking to hire folks, and we're starting to see even low end of the market, like not the low end, I would say the more kind of service sector type jobs, right? Think people in the service industries, like, restaurants and bartenders, and, people who are working in the, supermarkets and retail environments. They're getting huge incentives, sign-on bonuses to come back to work, getting somewhere $15 to $25 an hour, with pathways to make $100,000 in 2 to 3 years. I mean, at least that's one of the things I read about Chipotle, McDonald's talking about $20 an hour to get people to come back to work. So what does that do? That means everyone's wages are going to start to go up. Well, as wages rate go up, you start to see rents go up, but your asset costs are still fixed. So my point of all this saying is that inflation is our friend. And so when we see this kind of spike in the stock market, well, they're nervous because inflation means that there's a lot of change and turmoil in the markets, and the businesses in this economy are going to start to raise their prices, which we're already seeing. And so that really creates a lot of fluctuation in terms of the stability and what we've normally seen on returns. So all that to say, inflation is your friend. Who gets hurt by this whole thing? I'm going to just wrap this video up with saying that, look, if you're saving, if you're sitting on a lot of cash, cash is not a bad asset to own. I'm just trying to say, look, if you're sitting on $100,000 or 50,000 or even 20 grand, over time, the value of that money is going down. So you want to have that translated into some other physical asset or some other item that's going to be getting you a return. So you're not just losing year over year, your dollars just wasting away to inflation. So be thinking about that. It's always good to save money, always good to be kind of thinking about where to put it, but you don't want to just hold money for holding money's sake. You need to be putting it into an asset that's going to earn a yield, because otherwise, over significant period of time, 5-10 years, that value is going to go down and inflation is just going to chew it away. So all that to say, friends, that's my thoughts on inflation. What's going on? I appreciate your thoughts down below. Please hit like, subscribe. If you like what I'm saying, look forward to chatting with you on the next video. Thanks for checking it out.